Speculators and investors often have difficulty determining when to sell a stock. Many people sell their stocks before they reach their peak, while others hold on in hopes of a rebound. This raises the question of how to know when to sell. It's helpful to have some indicators to aid in determining the best time to sell stocks. When investors suspect their investment will begin to lose value, they are more likely to take the profit they already have rather than risk a loss. Although this appears to be counterintuitive, it is consistent with speculator behavior and how some stock market investors make decisions. While this appears to be a smart way to keep the value of your portfolio up, the stock market has a tendency to rebound, which can help a stock's winning streak continue. Some advise never selling winning stocks, those that consistently recover, while others advise selling them only when using a methodical approach. There are a few tools you can use to help you decide whether or not to sell a stock. Fundamental analysis, target prices, trading volume, and watching for reduced dividends are some of the tools you can use. It pays to have a stock exit strategy, regardless of which method you use. The ability to profit from stock, in theory, requires two key decisions: buying at the right time and selling at the right time. You must correctly execute both of these decisions in order to make a profit. The purchase price determines the return on any investment first. One could argue that a profit or loss is made at the time the item is purchased. The buyer simply isn't aware of it until the item is sold. While buying at the right price may determine the profit earned in the end, selling at the right price ensures the profit, if any. The advantages of buying at the right time vanish if you don't sell at the right time. Many investors have difficulty selling a stock, and the reason for this can be traced back to our natural desire to be greedy. There are, however, a few strategies you can employ to determine when it's a good time to sell and when it isn't. The most important aspect of these strategies is that they aim to remove some of the human emotions from decision making. If you own a stock that has had a good run, there are signs that it may be about to fall out of favor. There are a number of indicators that can alert you to price changes that indicate the price is starting to fall. Financial ratios are the most common form of these indicators. A fundamental analysis, which entails analyzing the issuer's financial statements, can be used to assess the company that issued the stock. Financial ratios are commonly used in the industry to provide information about a company's performance. Because current financial information is closely guarded by most companies, this information may be difficult to come by unless you receive financial updates from the stock issuers. You should take care that financial ratios are effective indicators of a company's performance over time. They can only be used to compare the performance of multiple companies if they are all in the same industry, have similar internal accounting procedures, and are otherwise comparable. You should be able to use measurements like dividend yield, price to earnings, earnings per share, and dividend payout ratios if you have access to financial statement data. Debt to equity, quick ratio, current ratio, and other liquidity, ability to quickly turn assets into cash, and solvency ratios or ability to pay debts are other important ratios to consider when evaluating a company. Many investors set a price floor on stocks so that if it drops below that level, they can sell to keep their profit. You can also set an upper limit for when your sale will occur. Your reasoning may be that you are concerned that the stock will struggle to maintain a market price above a certain level and that even a hint of bad news will cause the price to plummet. I want to make X amount of return, some investors simply state, and when I hit that, I'm going to sell and move on to another opportunity. This mindset can help investors make non-emotional stock trading decisions, which can lead to higher profits over time by avoiding panic selling. Other selling strategies include some event planning and strategies for events in the event of circumstances that are moving against your stocks and signaling the need to act. Growth stocks stop growing. Growth stocks are supposed to increase in value. It may be the best time to sell when they stop growing or their growth slows. Growth stocks that fail to maintain their growth are frowned upon by investors. Don't sell all your holdings. Remove a portion of your possessions from the table. If you have a good profit in a stock, consider selling a portion of it and reinvesting the proceeds in other profitable stocks. Leave the rest alone. This way, you can reduce some of the risk associated with your remaining stocks while still making a profit. If the rest of the stocks start to falter and flounder, you can sell the stock and walk away with a profit. Media hype. If a stock you own receives a lot of media attention and a lot of investment noise, it might be time to consider selling. These types of stock-feeding frenzies attract inexperienced investors, also known as speculators, resulting in a stock price increase. However, when the price becomes too high to be appealing, the stock will collapse. The hype will fade, prices will fall, and you'll be left with a negative return on your investment. Be mindful of frequent trading. While you should always try and get the most out of your investment, don't eat into your profits by racking up a large commission bill at your stockbroker. A few well-informed and well-researched trades will always outperform a dozen mediocre ones. When companies begin to reduce or eliminate dividends, it's a time to investigate the company's internal operations. As an investor, you should keep track of the companies that issue your stocks on a monthly and quarterly basis. A company's dividend cut is a serious occurrence that could indicate financial issues or changes that investors should be aware of. Companies are not required to pay dividends, so a decrease in dividends does not always indicate a financial problem. They could be reinvesting in the business, redirecting funds into retained earnings, or using expected dividend money for research and development. Dividend cuts aren't always bad. However, if you're only interested in the dividends, now might be the best time to sell. The bottom line of any profit-generating sale is a good sale, especially if the reasoning behind it is sound. It's also possible to consider a sale a good sale if it results in a loss with an understanding of why it happened. Only when selling is driven by emotion rather than data and analysis is it a bad decision. If you like today's topic, please tell us in the comments which part you found very informative to your own knowledge. Don't forget to like this video and subscribe to our channel to stay updated with new content.